Good morning. My name is Sandy Wolfwood, a member of the Social Justice Ministry Team and chair of the Eco Justice Team, both of which have joined together for the second in a series of climate change forums. We build the social justice forums around a common theme, and this program year our theme is diving deeper together so all will flourish. This theme builds on our heightened awareness of the systemic and critical issues affecting our community, brought to greater attention in recent years, most especially in response to the murder of George Floyd. Through the forums, we will learn about long-standing needs and become more prepared to support the flourishing of all members of our community. Tim Nixon is co-founder and CEO of Signal Climate Analytics, a provider of rankings on corporate leadership on climate change to Reuters News, one of the largest global news outlets. He is an ongoing contributor to Reuters Sustainable Business and serves as a judge for the Reuters Sustainable Business Awards. He's a founder and senior advisor to the United Nations Science, Business, and Policy Forum. But perhaps most importantly, and some of you may remember, he is the grandson of our own Faith Nixon, one of Westminster's first women elders. Just a couple of short notes to our audience before we begin. For those attending in person in the Meisel room, raise your hand and we'll bring a microphone and get your question on the recording, making sure that everybody hears it. And for those attending on live stream, please submit your comment, and Michelle Henry, who's monitoring that chat today, will bring your question to the room at large. And with that, I'll turn it over to Tim. Welcome, Tim.
Thanks very much, Sandy, and it's a great honor to be here and join Westminster's voice on climate change that has been so powerful over the past few years. So thank you very much for the invitation. I'd like to provide just a little bit of background before plunging into my presentation on my career. Before joining Signal Climate Analytics, I served as managing editor for Thomson Reuters' sustainability platform. This is Reuters News, the largest global news platform in the world. And in that capacity, I had a chance to interview many executives from corporate C-suites, policymakers, et cetera. And oftentimes what I found in these interviews was that I'd start getting into the corporate strategy, and the executive would make a fantastic claim about decarbonizing the business. And then after the interview, we'd go back and look at the data on the business and find out, well, actually, she or he was just talking about a tiny little part of the business, or the claims they were making about their decarbonization trends were actually not accurate when looking at the data. So I moved from journalism into data. And so today, I'm going to throw a lot of data at you guys, so bear with me. I've given you some trilliums here to sort of soften the blow, maybe help bring springtime along a little bit. But the data really is very important. So the way this presentation is going to work is, first I'm going to give you a little update on the IPCC latest guidance, the context for the problem, and then I'm going to show you what leadership actually looks like in the corporate C-suite. And then at the very end, we're going to touch on some of the more local opportunities, local businesses that have a huge really opportunity to become, and some are becoming, important leaders. So let's plunge into the context. Doing that, I'll provide a little bit of an update on the latest IPCC guidance that came out about a month ago. Many of you may have seen it, but what we learned in that guidance was that, do you think it's working again, or? Okay, great. So what we learned in this guidance is that, we all know we've been on an upward trajectory here in terms of emissions over the last 3 decades. And the guidance basically said, okay, not only is this trajectory no longer acceptable, and it looks like we're going to head off the chart here fairly soon, but we really need to start peak emissions. That is, emissions have to start coming down around 2025. And the guidance prior to that was 2030. So basically, we're burning up our carbon budget. And how fast do they have to come down? Well, really fast, right? Like this, to get to a reasonable possibility of a 1.5 degree world. So just looking at this, I think any objective observer would say we have a lot of work to do in a very short amount of time. And just to sort of place the accountability lens on where the responsibility lies for much of this problem, we hear a lot about China these days in South Asia. But if you go back and look at the problem as it accumulated for the last 150 years, we are at the top here both in terms of per capita emissions and aggregate total emissions contributing to the problem. And what's been happening during the last couple of decades as those emissions have gone up and up and up? Well, we've been having a little party, right? I mean, look at the wealth that's been accumulating in the coffers of investors over the last few decades. And by the way, if you were to overlay the emissions curve, it would basically follow this performance curve for the S&P 500 right up there. So there's a lot of wealth being accumulated, and the costs have been incurred by the climate. And so you may have heard at some point in the last 4 or 5 years about the growing importance of investors who are using sustainability as a way of focusing where their money is going to go to try to make the world a better place. And it makes a lot of sense. Why wouldn't you want to invest in companies that are actually decarbonizing or taking care of the rainforest or having diversity in the boardroom, et cetera? Unfortunately, when Reuters and other news agencies take a deeper look at what's actually happening in those portfolios, what they're finding is there's actually not that much difference between the so-called green or sustainable portfolios and the ones that aren't green or sustainable. So this is a really big problem, because it means that investors themselves don't have the data, they don't have enough disclosure to make materially different decisions about which businesses to invest in or not to invest in. So I want to dig into that problem a little bit. And I can't resist this comic, so forgive me, but yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for our shareholders. This is funny, but it's not funny, right? This is what's been happening. So the part of the focus of this talk is around this core concept that this is a manageable problem. This is not a hopeless situation. And one of the reasons it's not hopeless and manageable is that it just so happens that about a third or so of annual anthropogenic emissions, human-caused emissions, are concentrated in around 200, 250 or so C-suites. Okay, so that means that we could probably pack all 250 into this room if we really worked at it, right? I mean, that's an incredible amount of decision-making power in an incredibly small number of people. And these folks are some of the ones right at the top of the pyramid. So these are the CEOs of 12 of the largest oil and gas companies in the world. Okay, and together, they account for about 15%. Imagine that. 12 individuals, 15% of annual anthropogenic emissions. And this slide is not a naming and shaming slide. This is about who are the leaders, right? And asking the question, where are they on their journey? Because you'd be wrong if you looked at this and you said, well, these guys are all villains. This guy over here who leads Equinor, he has a plan to decarbonize Equinor, an oil company, and turn it into an energy company by 2040. I mean, it's a detailed, credible plan, okay? This guy who leads Saudi Aramco doesn't have a plan. He doesn't even disclose the impacts of the oil that he puts on the market. So, looking at this slide, it's important to understand that these leaders and many of the other leaders of those 250 firms I was talking about are all at different points on their journey, and they're all headed in a direction, usually to slightly better states of disclosure and decarbonization. But knowing where they are and where they're headed is critically important. So how have we been going about sort of doing that assessment? Essentially, as I mentioned before, I used to work at Reuters, and we still do at Signal Climate Analytics work with Reuters. And we've been focusing on this top 250 group, as I mentioned, for good reasons. That's where the concentration of emissions are. And we've been asking just basic questions. Who are these companies? What do they say they're doing and going to do? What are they actually doing, which is different than what they say they're doing, we found out. And most importantly, who's leading them? And why is that leadership question so important? In part, it's because time is running out on climate and the time to bend that emissions curve back down. And frankly, there's nobody better positioned to make decisions to start bending that curve down tomorrow than the leaders of these firms. It's not policymakers who might eventually pass a carbon tax. It's not consumers who might eventually figure out the impacts of what they're buying. It's the folks who lead these businesses. And so one of the reasons I really wanted to speak today is because the leaders of these businesses, they live in ecosystems of churches, clubs, families, etc. And I think Westminster, and I think Grandma would agree with this, has the privilege of being in a position to potentially be a part of that discussion with some of the local businesses and maybe more globally. And I'll get to the more local businesses at the end of the talk. But we are a part of the ecosystem. We are a part of that leadership matrix. So I want to talk a little bit now. I'm taking us further into the weeds now, so bear with me, on the way we measure leadership. Okay, because I mentioned earlier that investors have a hard time doing it. So what we think about is first of all this idea that my business partner, David Lubin, wrote about 10 years ago or so, maybe a bit more, in the Harvard Business Review called the Sustainability Imperative. And the basic concept of the sustainability imperative is that as leadership takes hold in a carbon-intensive business, and it starts to figure out how to disclose, first of all, and then transform itself into a less carbon-intensive business, certain opportunities will emerge, financial opportunities, for those businesses, whether they're an automaker, an oil producer, utility, whatever, to differentiate themselves from the competition, to start producing goods and services that have a slowly lesser and lesser carbon impact, carbon footprint, right? And the idea of the imperative is that businesses that can figure that out first are going to have an incredible opportunity to flourish. And why does that matter? It matters because if we can capture the power of the markets and measure where this is happening in a business and correlate it with financial outcomes, then the markets can be unleashed on the problem, right? We can roll the big boulder downhill instead of uphill, telling companies that they really should get their act together or else. We know that hasn't worked, right? So how do we measure performance here and then correlate it with good financial outcomes? And the way we do it is we think about the sustainability imperative. There is this opportunity. And then we ask the question, as we did in this report for Reuters, on transparency. Well, what's the pathway to disclosure? What do companies look like as they become more open and transparent? And then finally, in this last report we did recently on the auto sector, just as an example, what does it actually look like when a business transforms? Not what they say they're going to do, but when they do what they say they're going to do. And so the matrix here in the sustainability imperative is that we try to sort of group companies into different categories. And what we do is we think about, on the y-axis, to what extent do they have a strategy, a plan for transforming themselves? And on the x-axis, to what extent do they have the capacity to execute on that plan? So what you end up with is what we call the winners up here, like I talked about earlier, those that have both the plan and the capacity to execute on the plan. You've got the losers. Yeah, that sounds kind of harsh, but that's what they kind of are, and becoming more so. They don't have a plan, and even if they did, they couldn't execute on it. You've got the defenders. They have the capacity, but they're not really working on it much, right? They're sort of holding out, milking the value of their assets, and there's a lot of companies in this category that are into delay, right? Keep on leveraging the business models that they have for as long as they can. And then, of course, there's the dreamers. They have a great plan, but very little ability to execute on it. So this is how we think about companies, sort of broadly speaking. And just moving to the question of disclosure and measuring disclosure and transparency. What we observed in large carbon-intensive businesses in our work with Reuters a couple years ago is that there's actually a repeating pattern that occurs as businesses become more and more comfortable disclosing their climate impacts. And this pattern plays out oftentimes over a period of a decade or more, actually. And what happens is businesses start out at the beginning and they say, okay, we should acknowledge in our corporate reporting that climate change does matter for our business, that it presents risks and opportunities for us. So you'll see a statement like that. And then after they've sort of gotten their arms around that, they oftentimes will start disclosing the emissions impacts of parts of their business. So, for example, just picking on Saudi Aramco again for a second, Saudi Aramco is really, really eager to tell you about how efficiently they can get oil out of the ground. They have to spend almost no time and energy with very little carbon impact getting their oil to the marketplace, okay? So that's a description, and you see this a lot in carbon-intensive businesses, of a part of the business where they're doing better than anybody else in their sector. And why is that? Because it just bubbles right up out of the, out of the desert, right? Of course, what matters is not that part of the business. It's what happens to all of that oil after it gets to the marketplace, right? So what are those numbers? And those aren't numbers you see from them, okay? But they have the most efficient wellheads in the world. That's what you see here at this stage. And then after this stage happens, then you start to see targets around those stages that they're comfortable reporting on. Okay, so they're sort of completing that first loop. And then there's this really, really big step that a lot of companies have yet to make. We call it dominant scope emissions reporting. Picking back again on Saudi, that's the impacts from the burning of the oil, right? Or with Boeing, the use of the airplanes, or Ford, the impacts from having F-150s being the best-selling car in America for the last 30 years. This is a big, big step for companies. And to make it a little more complicated, and just to kind of put your cultural psychology hat on again, I mean, a lot of times when companies are faced with this decision of whether to report this, and they do, they look worse, right? So there's a kind of a perverse almost incentive in place that when people see the number, they're like, oh my God, how could they have been doing this? When in fact the company is doing better in terms of becoming more transparent, more engaged with its stakeholder community. And I think that it's important, even with these firms, to have some degree of empathy. It kind of goes to the prodigal concept of the talk, that this is a journey. And these companies provide goods and services that all of us use, all of us, and will use. So that, this is not a black and white, good and bad situation. This is about a journey towards becoming a more responsible corporate leader and stakeholder. So after dominant scope emissions reporting, we get to complete. So that's everything, the whole business, back up the value chain and back down the value chain after the product is sold. And then finally to science-aligned targets. So these are targets that basically allow an observer to say, okay, this business is decarbonizing over the next decade or more at a rate that's consistent with 2 degrees of warming or less. So I think this is really interesting. I mean, and this pattern it plays out across all different kinds of businesses and all different kinds of sectors. But it takes a long time. We don't have a long time. So in June of last year, we reprised this work with Reuters. Went through all of the 250 again just to see where they were. And you can see the headline here, just 11% of the 250 biggest emitters plan major cuts by 2030. And the way we did this work is we thought, okay, well, how do we take all this data, all the circles and all of that, this and then that, and make it understandable graphically, easily for observers? Because frankly, that's part of the problem here, is that there's so much complexity in what firms are saying or not saying and the numbers they're reporting, and are they comparable? It's just really, really complicated for anybody to get a handle on this stuff. So we said, okay, for each step in that journey that I just talked about, we're going to award Toyota here a bar. And the easier steps are smaller, right? So Toyota's got a policy, and in fact, they get all the way through to having targets that are aligned with science. And you can see here we've added another targeting step. And this is really important. It's not just having a target, because you're probably seeing in the newspapers these days a lot about these net zero 2050 targets. I mean, they're all over the place, right? Everybody's got their net zero target. But if you dig into it, what you find is that for a lot of firms, there aren't any targets before 2030. And the net zero targets are all about putting in place innovation like carbon capture and storage that doesn't exist yet at scale. So, there's a lot of greenwashing going on around net zero targets. So what we did is we said, okay, we'll give them a bar for having a net zero target, but really, do they have a net zero target that includes their dominant emissions type and meaningful measurable steps before 2030? Okay, and really, frankly, we should be probably talking about 2025 now too, given the latest guidance. And when you start getting to that level of granularity on these firms, they start to drop off. So I'm going to show you a couple views of the underlying data that power this article. Here's the utility sector. And this, by the way, continues on with about 40 more companies, and they only get less and less transparent off the screen here. So you can see we've got just a handful. Most of them are European. Excel, by the way, in our own backyard is one of the leaders here. But just a handful that have the level of ambition necessary to keep us under 2 degrees of warming. I mean, it's astounding. So hang on to your hat. This is the oil and gas sector. Now, this is the sector that's most responsible for global annual emissions. And, there's probably a little bit of updating that needs to be done at the very top of this to add another bar for a couple more of these. But, look at this. This is dispiriting, to say the least, right? And this is not just about oil and gas, by the way. This is also about methane. Because a lot of what's coming out of these wellheads, and I'll get to this in a little bit, is a lot of methane, more methane than we thought. And that is a really big short-term climate problem. So this sector here is, it's really where a lot of the action is, not just on how we power our transportation system, right, but how we generate electricity, because that methane, that natural gas, that finds its way to utilities. But if there's all kinds of leakage upstream, is it really better than coal? It's a big question. So that's a look at transparency. And that's really the first step in being able to understand, where is a business, how serious is it on its journey towards transformation? And transformation is about transparency, but it's also about, like I said before, doing what you say you're going to do, not just saying the right things. And so the way we think about measuring this in a business actually comes from, again, my business partner, David Lubin, who used to teach developmental psychology at Harvard before he left that role and started doing data work. And so the way we think about this is cultural. It's about the leader and the leadership team. And what we do is we ask the question, so what are the stages that firms typically go through as they develop more and more of the capacity to capture that sustainability premium? And this is how it works at a high level. At this initial stage, companies are focused on risk, avoiding getting fined, plugging leaks in the buildings, just basic compliance tasks. And at this stage, this is where you start to see those early sort of steps in transparency around policy and target setting for parts of the business, but not the whole business. And then if they sort of manage through that process, and most of the oil and gas sector, by the way, is here, stage 1, okay? If they get through that, then they start to think, well, geez, maybe we should, start reporting out more of our footprint. Let's set more ambitious targets. Let's set up a green team. Start to sort of build culture and capacity around transformation. They get through that step, and this is oftentimes 4, 5, 6 years, right? Then they start thinking, well, geez, maybe our sustainability strategy could drive our product development plan, produce innovation, attract talent that we didn't know we could get, start to drive revenue growth. So these big goals start to emerge, right? The imagination starts to open. And then in a very small percentage of large carbon-intensive businesses, you see them start to say, okay, we've figured it out. We can differentiate ourselves. We can outcompete our competition because we are transforming. Big gains. Products and services that are decarbonizing or decarbonized start to emerge. And so what happens when you start to measure this stuff, and there's all kinds of data that goes into each one of these steps, and I'm not gonna I'm not gonna force you guys to work through that with me, but trust me, there's a lot of data that goes into measuring these things. And what ends up happening is you can say, okay, you know, a company at the top here is starting to produce growth and productivity that's green. You know, profits that are green and new revenues that are green. And their risk is going down, regulatory risk, consumer risk, et cetera. And conversely, companies that are at the beginning of their process are looking at a lot more risk than opportunity. So what that means is, and this is, I know this is really wonky, but it gives us a chance to say, okay, you know, this is measurable, this ratio of opportunity to risk. And once it's measurable in a business, you can ask the question, okay, so is there any correlation between companies that have a higher sustainability ratio, more opportunity than risk, to better financial outcomes? Again, we want to roll that markets boulder downhill, right? Okay, so this is a lot. and really just to simplify this, what this is applying that sustainability ratio methodology to the auto sector. So here you can see all of our friends, Tesla, through Mahindra and a whole bunch in between in the auto sector. And what we've done is for each year over the last 5 years, we've calculated the sustainability ratio, the ratio of opportunity to risk in each one of these businesses. So you can see the trend, right? And you know, not surprisingly, you see completely decarbonized automakers at the top, okay, et cetera, going all the way down to some automakers that are actually carbonizing. Their fleets are becoming more carbon intensive. And then we come over here and we can see, well, geez, average total shareholder return for this top grouping, again, going back to our leaders concept, 41.3%. And you can see the diminishing returns as we move down the leadership rung. And so this is exciting because this isn't something that we're just seeing in the auto sector. We're seeing this in other sectors as well. And so if this continues to play out, what it means is that the markets and investors don't have to go to their asset owners and their customers and say, well, if you want to pay a little bit more, you can get a green portfolio. No. You actually can get a premium, right, on your more sustainable investment if you have the data, if you have the insight. And that's a big if. So one quick thing on the other sectors in the next 5 or 6 years that matter most, I think it's pretty much the expert consensus that electrifying transport and the auto sector in particular is a key step for us in the next 5 years. The other two sectors that most experts agree matter most are utilities. So how are we going to power all that electrified transportation, and oil and gas. And like I said before, oil and gas is really, for us, one of the biggest concerns in an area where we're going to focus more because it's not just about all the oil and gas. It's about methane. And here, this is a deep dive view into some of the steps we look at within the oil and gas sector. But what is the methane emissions intensity of an oil and gas company? You know, and is it actually reducing that intensity over time? So is it reporting a number, and is it reducing its performance on methane? This is really hard to measure because big oil doesn't like to report these numbers. And the numbers they do report have been really difficult to validate. And Reuters did some work on this. And what we're doing also with Reuters is we're partnering with a satellite measurement company, another startup based out of San Francisco that has figured out how to measure wellhead venting at the 1 kilometer square level. Nobody else can do this. And they can attribute that venting to specific owners of those wellheads. And this is a bit of a preview on report work that's going to be coming out in June from us. But the methane emissions trends in these top 100 energy producers are rising. They're rising. And as we start to focus on the upstream infrastructure for both utilities and oil and gas, what we're seeing is that, unfortunately, for some sources of natural gas, the climate impacts are actually worse than coal. Okay, and that includes the Russian source at the top of the list. Okay, and North America is not far behind. So we've been sort of told that natural gas is this bridge technology to allow us to buy time and save the climate. It's not clear. And so in the next few months, we're going to be coming out with more data, more capacity to measure performance of oil and gas companies and utilities on their upstream methane venting. And we think there's some evidence emerging that for firms that can produce lower intensity natural gas, they're plugging the leaks essentially, and there are some of these, that there'll be a price premium, a sustainability imperative that emerges for those companies. And that's, again, the kind of market outcomes that we're trying to drive. But I wanted to spend a little bit of time on this because it's a really, really important issue. And we're trying to get the word out on it. Last thing to say about this kind of measurement, where we're measuring firms directly rather than dependent on their own reporting, is a wave of the future. And we think it's going to change the veracity of a lot of what we see in some of the sustainability reporting now. Because you can't argue with this stuff. It is what it is. Okay, so that's the deep dive data view on what leadership looks like and how we measure it. And in the last 12 minutes here or so, I thought it might be interesting to take a look in our own backyard, in addition to seeing a Rue anemone, which we'll also be seeing those pretty soon. So what I wanted to do is just sort of set the stage a little bit. This is, what we call the Global 250. And these are the largest carbon-intensive businesses of the world. And this is, as of about 4 or 5 years ago, the latest reported information on the top 10 global emitters. So here you can see coal India at the top. And for 2016, they had complete combined scope 1, 2, and 3 emissions of just over 2 gigatons. And 2 gigatons is about 4% of annual anthropogenic emissions. Okay? So that's a very, very large amount of emissions concentrated in one emitter, and et cetera. You can see just looking down the list. I just wanted to give you a sense for what the numbers look like at the very top of the pyramid here. And then if you get down to the bottom of the 250, you're talking about like Lufthansa here at 41 megatons. So just a fraction of coal India, but that's still a lot, right? And like I said before, this grouping of companies represent about a third of annual anthropogenic emissions. So it's a huge opportunity for improvement, for moving the needle with a relatively small number of leaders. And by the way, we're updating this data now. And not to keep coming back to these guys, but you know who you'd see at the very top? Any guesses? Saudi Aramco. At probably close to 5 gigatons. Okay. So what I thought would maybe be kind of interesting is just to say, okay, well, what about in our backyard? Who has a leadership opportunity? And the first one I just wanted to show you, and this is a screenshot from a data service from the London Stock Exchange Group. So this is actually what investors use for understanding businesses. And what I've done is in red here for Xcel Energy is I've just drawn a square around their overall emissions for the last few years. And what you can see is Xcel is at 38 megatons here for 2020, 48 2019, 50 2018. So this is a really good story. I mean, you don't see this very often. And they're right here. I mean, they are our primary energy provider. So I think, there's reason to be proud of this. And they have granular, ambitious decarbonization plans going forward. So that's an example of a leader. A couple more here I thought you might kind of find interesting. So Delta Airlines, 2019, 38 million megatons. 36 before that, 35. So this is an example of a business that is transparent. They're doing what they can. But airlines, it's it's a tough sector because there's only so many gains you can harvest by, improving the way you fly your airplanes and getting more efficient airplanes. This is all about jet fuel, right? And most jet fuel right now is not coming from renewable energy sources. It's fossil fuels. So this is what I would expect to see in an airline that's growing its capacity over time. But it's really important to know how much they do contribute. So remember, if you look at 38 megatons, that's just below the 250 line. So Delta is in the family, right? Target, we all love Target. I love Target anyway. But look at this. 52 million megatons, right? 52. And here, interestingly, 2017, they took a step forward in their transparency, right? It wasn't 12. It was close to 52. But here they decided to disclose more of their footprint. And what part did they disclose? They disclosed the upstream emissions from all of the manufacturing and all of the agriculture work, everything else that goes into bringing all of those products into the Target store. It's called Scope 3 upstream emissions. So that was a brave step. They looked a lot worse. Actually, they were better. They were more transparent. But this is a lot of emissions. And this is in the 250 target, our own target. So I guess, when I looked at this, I thought, do we really know enough about Target's trajectory here? When we go to Target and start shopping, what is their trend? What is their plan? What is the impact of all the products we just purchased there? I don't know. I know I don't know enough. I just have this high-level data, and most people don't have this. So this is now a quick view of the agribusiness sector. And what I wanted to do was just start with a peer for Cargill, which is this Bunge, and give you an idea of the level of emissions that comes from a commodities agribusiness. 83 million megatons, right, on revenues of $41 billion. Okay. So then I thought, well, let's go look at Cargill. And Cargill's different than these other companies because it's not publicly traded. And private companies don't tend to disclose as much as public companies, even though many of them are huge super emitters, like Cargill. So I went to look at Cargill, and this is their revenue statement. So if you look at this, $41 billion in revenue produces 88 megatons. 134 billion in revenue produces how much? It's not disclosed in the investor frame by Cargill. But it is disclosed in some place called the Carbon Disclosure Project, which is not easy to access and understand. But if you dig hard enough, and this is a whole question around, is this really transparency or not? You can find this, 146 million megatons. That's a lot. That's probably top 100, maybe top 50 in the world, okay? Right here in our backyard. And do we all benefit from a lot of the work that Cargill does globally to bring food to the table that we can afford? Of course we do. But we gotta know where the source of the solutions are, right here in the upper Midwest. And this is one of them. We should be watching this company carefully. And finally, kind of an interesting story here. I thought, well, what about Honeywell? Let's take a look. And with Honeywell, we have that same story of a company that's just not comfortable putting their numbers out. And then they began to, in 2019, here at 16 million megatons. The 2020 number is similar to that. But when you go and you ask experts, say at CDP, to assess what's more likely the full complete emissions profile for Honeywell, you're probably looking at somewhere around 50 million megatons. So this is not a naming and shaming exercise. This is just where Honeywell is on its journey towards being more transparent. Do they need some encouragement from their stakeholder community? Maybe, because this is not where we need them to be, probably. But these things really matter, and it's important to know where these companies are right here, because it gives us an opportunity to think about how the church could potentially engage with some of these businesses. So to sum up, and then I'd love to have any questions or discussion. The journey, becoming a leader is a journey, and it requires encouragement, maybe even pressure from stakeholder communities, but it also requires empathy and honesty. These are businesses that provide services and products that we all use and frankly sometimes need. And measuring where these companies are on their journey, it's complex. I just gave you a little flavor for it. It gets a lot worse than this. We should be cautious about oversimplified assessments of company performance, especially from the companies themselves. And encouragingly, leadership seems to have a link to values. So having values increasingly has value in businesses. And finally, it's not enough to know where a business is now. You gotta know where it's headed and how quickly, because ultimately, this is about transformation at a rate fast enough to preserve a chance at a 1.5 degree world, or at worst case, a 2 degree world. So knowing that momentum, that trajectory, the rate of change is really, really important. So thanks very much for your patience. I know this has been a bit of a wonky, data-driven presentation, but I hope it was helpful and interesting, and I'd be happy to take any questions or comments. Yeah. Yeah. Here you go.
I like the wonky data-driven presentations. I don't get to sit in very many of them, and I enjoy them. But I had on this, you mentioned the complexity of determining the data, and I had one particular question, and that is how you address the double counting. That, Exxon pumps the petroleum out of the ground, and then the Koch brothers refine it into gasoline, and then Ford makes a product that burns that fossil fuel, and Uber buys those up and runs them all over town, giving people rides. How do you determine the upstream and the downstream layers, and how do you have kind of a net value added number?
Yep. So that's a really, really good and important question, because these sectors are all linked together. Like you said, if you look at Ford, and you say Ford is responsible for not just the emissions that comes from making its cars, but also the use of those cars. And then you also say, well, but Exxon is also responsible for those emissions because that's Exxon's oil. So that's double counting, and that's not fair, right? So the way we address that is we say, well, actually, each one of those businesses is benefiting financially from that business model. Exxon, the combustion of oil, and Ford, the use of incredibly inefficient F-150s for the last 30 years. So to properly understand climate impact for a specific company, you got to look at the entire impact, not just of the making of the car, but the use of the car. Is the automaker investing in more fuel-efficient cars, electric vehicles, or have they chosen just to continue to produce gas-guzzling SUVs and pickups? So there's an accountability that comes within an individual business looking at the entire range of impacts, including use of product, including manufacturing, et cetera. Now, that said, when you have this discussion about impacts, you also have to acknowledge that there is double counting going on when you look at all of the companies in a list. And by the way, when I said a third of annual emissions from that 250, that's taking out the double counting, okay? So for all the automakers, we don't count the combustion of the oil and gas in the cars, just the production. But for all the oil and gas makers, we do count that combustion, okay? So that number still holds. But it's our view that in order to get a better picture of the opportunity for a business to drive positive impact on climate, you have to look at the whole spectrum of impacts, everything from the products and services that they buy upstream in their value chain to what happens in the business itself, and then what happens after they sell their products and services out in the marketplace. That's really the holistic view of climate impact. It's a kind of a long, complicated answer. I hope that answered your question. Okay. Any other questions or comments?
We want to capture it.
Oh, okay. All right. Well, thank you very much for this presentation. It's
Sure.
enlightening. I have a couple of friends who work in the solar sector, and I'm wondering, they report that Xcel drags their feet to the point of hobbling the solar industry in Minnesota. Just the other day, Councilmember Lisa Goodman took Xcel to task in front of a committee for slowing down local energy, local solar projects. So given that they're showing up as a leader on the charts here, what does that really say, given that they are actually working to slow down solar from the solar industry's perspective? That's the first part.
Yeah.
Second part is, it seems like a great idea to position the church community as a way to impact these companies. I understand that the church owns an oil well, and so how? Not anymore? Oh, good. Okay, so I guess the question is, has the church gone through a process of kind of looking at their own investments?
So I can answer the first question, and I think, Sandy, you may be better at answering the second question. So with respect to Xcel, I'm not familiar with the specific action that you talked about that Xcel is taking or trying to take. It doesn't surprise me, frankly. I mean, these are very big, complicated businesses that have different agendas locally in different places. What we do is we look at the higher level performance for the whole business. So presumably, if Xcel has a target to decarbonize by 50% by 2030, and it's something about where their target is, they're at the C-suite level, they're making all kinds of decisions around where to deploy resources most efficiently to get to that goal. Okay, and if you look at Xcel and their level of ambition and their actual record of decarbonization business-wide compared to other utilities in that sector, other companies in the utility sector, you just don't see that level of ambition that often and accountability. So yeah, I'm not surprised that strange things happen in big businesses, including Xcel here. But as a whole, I mean, I think having the bigger picture is really important, even if sometimes locally it doesn't make sense, and maybe it just doesn't make sense. Maybe they shouldn't be doing what they're doing. That's the best answer I can give on that one. Thank you. Yeah.
And just to follow up, one of the forums we had hoped to do this spring and we intend to do, and we have a trustee in the room, is to bring you a picture of how Westminster has modified its investing strategy related to this topic. Jeff, did you want to say anything to that?
Yeah, I'm looking forward to reporting to the congregation on how we are. And it's been a couple-year progress now that we made in investing of bad things and getting into better things. Off on a little bit of a tangent, the oil well example that was brought up really brings up the complexity of the problem. Yeah. And that was that infamous oil well that Westminster owned was a gift many years ago, and we took advantage of the production of it and the profits of it for many years, and then we began to have some angst and divested of it eventually. But it did a lot of good in the time, of course, and I'd encourage anyone who wants to divest of oil stocks to give them to the church, and then we'll divest them. So that I have to give credit to that infamous oil well. There was a member who did a lot for the church in that story.
Yeah. Sandy, can I make just a quick comment on that? Yeah. So while divestment is a valid strategy for green investors and climate activists, we also see actually investment and engagement as potentially even more important. So where you have a business that isn't in that defender category, they don't have a plan, and even if they did, they couldn't accomplish it. That's not a place for engagement in investment. But where you have a business that has a plan and some capacity to execute on it, even if it's a big carbon-intensive business, that actually may be an opportunity to invest and get in and encourage demand as a shareholder that the business accelerate its level of ambition. So divestment is not, like everything in this space, it's not black or white.
Thank you very much for the presentation. It was
Sure.
very illuminating, one of our members said.
Thank you.
The next question was, what are the effective actions that shareholders can take? That's one. And then, do shareholders' proposals offer effective ways to connect with leadership?
Yeah. So, I mean, I think we're seeing more and more evidence, such as, for example, the recent work by Engine One. You may have heard about this in Exxon. Engine One is an activist investor shareholder in Exxon. They own a big part of Exxon, actually, relatively speaking. And they forced Exxon to put 3 new board members on their board of directors who have competency around climate risk and opportunity. And Exxon didn't want this. The CEO didn't want this. But they got it through. Okay? And so those sort of small steps towards improving governance at the board level are starting to succeed and have potential to matter. And then just with respect to what investors can do, first of all, you got to have the right data. You got to know where a company is and where it's headed and how fast. And just keep in mind that divestment may not always be the most effective solution to producing change in time to matter.
I guess I have a question then tailing off of that. How can we as people and just community people, not just church members, have those more transparency, just demand more transparency, more governance that is climate driven?
Yeah, so I firmly believe the most important thing to do is vote. Vote. You know, it's policy making. It's getting more of what the SEC is doing now around requiring disclosure of emissions and emissions impacts. That's the single most important thing we can do as a community. The second most important thing is just, you know, be aware of opportunities in terms of relationships with leaders in the community, especially a church like this that's positioned as a leader already. And maybe third, be aware of your own impacts, right? How much greenhouse gases it take to fly to London for your next trip, or drive across the country? The small things that most of us in this room probably already do that do add up.
I have a quick question, Tim, about the stories you were telling about this. The second time I've seen your presentation, and seeing it a second time helped me get further along in the journey of what you're trying to do.
Thanks
here.
for coming back.
Yeah, it's great. I can't get enough of the data that you you present in the way that you present it, because I think it tells the story in an effective way.
Thanks.
My question is, how do you get that out there? And are there plans? Do you use social media? How do you start telling the story?
Yeah, so I do have a little bit of news on that front. So, like I said, I'm the CEO of the small business, and we were just funded by a really large global investment bank that has the same values that we do. So we're now in the next 12 months or so going to be able to scale up our research. So you're going to see 12 reports in 18 months at the sector level that detail the kind of work I showed you today, starting with transparency. So reprising all that stuff on transparency for the top 250 coming in June. So we're really excited about the chance to make a difference with that.
Well, I'm thinking maybe pushing it further into getting it to the level where people, the social media wasn't the,
Right. Well, so that's why we think the Reuters thing is so important.
Okay.
Is it's way more complex right now than it needs to be. Okay. And that complexity actually helps preserve the status quo in many cases, because it's hard to know what's happening. So we want to simplify, but through insight.
I think at this point we need to call it to a close, but thank you so much, Tim, for coming back and presenting this. And I'm glad this is recorded. So if those of you know people who might benefit from this presentation, it has been recorded this morning, and I would welcome you to ask Tim some questions right after the presentation. Next week, gotta put my glasses on. Next week, we welcome Adair Mosley, CEO of Pillsbury United Communities, to share the work of the Pillsbury United Communities development work in North Minneapolis and highlight recent successes and ways that we can help support those efforts. So I hope you come back and see you then. And thank you for attending the last 3 weeks of the Eco-Justice. Every year, Eco-Justice takes 3 Sundays to present, and I'm glad to do that, and we'll bring back some more things related to the questions that were asked today as well, especially around Westminster's role in moving some of the issues that Tim talked about today along. So thank you so much.